Hello, this is Smart Money. My name is Kura, Chihota, and I have my trusted financial companion, Mr. Warren Ingram, by my side today. Welcome to you.
Thank you, sir.
When we speak about portfolios, a picture of assets and their different values should come to mind. Multi-asset investing is the process of combining different asset classes such as equities or bonds to gain local and international exposure, and sometimes making use of non-traditional approaches such as alternative investments. Because it's still a relatively new way of investing, it can be defined differently according to who is working with it. Some define it through a number of asset classes in the portfolio, others by the types. Of course, if you've got any investments like these, you're going to have to consider the element of risk and reward. That's a hell of a mouthful that I just said right
Do you need a break?
Indeed. Let's build it up. Asset classes, alternative investment, portfolios, all of that jargon, smart money. We break all of that stuff down and we just talk. Two oaks having vodka on set, talking about money. Investing.
Okay.
Asset classes. Wat gaan aan?
So what happens is you take your money and you've been building it up and saving it in the bank,
Yep.
and so that's great. That's saving. Now you need to transition from being a saver to an investor.
Okay.
Why? So let's just start there quickly. Why? Because if you don't, your money's never going to beat inflation.
Okay.
So
Can I say passive active? Are we?
No, we're not there yet.
Not
We're
yet.
there
Okay.
Yet. Let's not throw too much jargon.
We can get active. We can get investments that are passive.
Exactly.
But being a saver is passive because you just like taking an interest rate.
Yeah,
Okay.
and that's great, and that well done. And you have to keep doing that. Don't stop doing that. But if you want your money to beat inflation, that means you have to take risk. That means you're gonna buy things that are hopefully going to grow faster than the inflation rate. If they're going to do that, they're not going to do it like your bank account where they go up in a nice smooth line. They're going to go like a roller coaster. Typically in our lives, that means we're going to need to buy, in some way or another, we're going to need to buy shares in companies. We're going to need to buy properties. We're going to need to buy government bonds, and then we're going to still have some cash. Those are asset classes. And I know it's a nice jargon and all that stuff, but actually that's what it is. Yeah. And you can buy those through unit trust. You can buy them directly. You can buy them in a multitude of ways in your retirement funds, etc. So don't get too caught up in a unit trust or a retirement fund. Yeah. It's understanding what's inside those things, and those are the asset classes.
Okay. So I'm told there's no such thing as a free lunch, but compound interest is pretty much one of them. I hear that diversification is going to be the closest thing to a free lunch that there is. What is diversification when we're talking about a portfolio of investments like you've got?
So now we say, okay, great. I need to beat inflation. The problem is my asset that's going to do that statistically. If we look back over the last nearly 150 years, the asset that will do that most regularly will be the stock market, buying shares in companies. That's great. Unfortunately, it's also the one that's the most risky. So you don't want to take all your money and buy the most risky investment at the worst possible time. Okay. So what you do is you say, okay, let me take some of my money and buy government bonds, which are not as great in terms of growth, but they're much less risky unless you're buying Greek bonds. And then you buy some property, and you mix them together in a portfolio. So that's the diversification.
So diversification is spreading risk, so you're not exposed to one particular asset.
Exactly right. So you don't want to be in a position where if the stock market falls, all of your money's fallen. Sure. You've got, hopefully, there are times when other investments are doing better, when some are doing worse, and that's where the free lunch comes in. Because over a longer period of time, the theory is that having a mix of assets will work for you and actually grow your money more consistently than being in the roller coaster ride just of the stock market.
So you rocket scientists, you call this risk, you guys call it volatility, this up and down.
To me, volatility, exactly, it's just the investments going up and down. Is it risk? No, I don't really think it's risk. Risk is that your money doesn't beat inflation over a long period of time. That's a real risk. And we find a lot of savers have that problem because they don't want to see their money ever go down. So they keep it in the bank and inflation wipes them out. The second risk is you make a really bad investment decision where you lose money permanently. You never, so the stock market's just doing that. That's okay if you stay invested. But making a bad investment decision means you buy at the wrong time, you sell at the wrong time, and you never recover the losses that you've made. Those are the two real risks for me. Volatility, it's like the tide. We can't control the tide. The tide's going to come and it's going to go. We're going to have to make sure that we can live with all of that.
Sure. But if I want to dive off the jetty, I'd like the tide to be high.
Make sure that the tide's right for you at the time. Yeah.
Sure thing. The asset allocation is the percentage we put into each of these, and I'm sure there are personal needs that drive it, and then there's scientific methods that we can use, and we build up a portfolio of saying, Kura, this is what this has done in the past, this is what you need in the future. You put that together, and some bright spark like you will tell me how it all works.
Yeah, we'll need to find that bright spark. So what happens is you look at your age. That's a really big determining factor. So if you're younger, you need more growth. So then you would have a greater amount in shares. If you have a low tolerance for risk, which is a psychological thing, then you would have less in shares. And then it's the time frame that you want to invest for. So if you're only going to invest your money for the next 2 years because you want to put it down as a deposit on a house, guess what? You can't go into shares. So those are the three big factors that will help you make that asset allocation decision.
Big words will fall on the show. Please join us, because after the break, if you're considering multi-asset investing, diversifying your portfolio, we've got a great expert in on the other side of this break. We'll see you just now.